My name is Jim and I was retired. In this week's short video, we're going to consider the tax tripwires in Roth conversions. So in earlier videos, I've talked about how it's important to plan some Roth conversions very carefully. You don't want to do those big, bulky Roth conversions that are going to trip through a bunch of tax tripwires. There are expensive ways to do Roth conversions, and I'm on a plan to do them as very modestly as possible, just up to the tripwires, but not over them. Now, I've talked about some of these tripwires in a prior video. I'll go over them briefly here. At $80,800 worth of taxable income, your capital gains is going to jump from 0 to 15%. Adjusted gross income, this is before taxable income, of $107,450, your tax bracket for your taxable amount is going to jump up to 22%. That's the big one there, $176,000. Your first IRMAA surcharge would add about $713 a year annually to your Medicare Part B premium, and there's a similar IRMAA charge for your Part D that you need to consider. And then $199,150 is when you'll jump up to the 24% tax bracket. For my case in New Jersey, that includes some special tripwires, which I'll go through. The first tripwire is 100% of my retirement income is New Jersey tax-free if I can keep my total gross income below $100,000. Between $100,000 and $125,000, the exemption is 50% of the retirement income. Now, between $125,000 and $150,000, then you're going to get a 25% of your retirement income will be excluded, meaning 75% of your retirement income is going to be taxed. And if you go over $150,000, all of your retirement income will be taxed by New Jersey. So those are some big tripwires for me. Now I built a spreadsheet, which I'm going to show you, that'll show you some of the effects of those tripwires on your total tax hit in a given year when you're considering Roth conversions. Hey, did you like and subscribe to this channel? Because if I can get 1,000 subscribers, that community page opens up for me. So let me get to 1,000 subscribers. Like, share, and subscribe. So in my scenario for a married couple filing jointly, I'm going to assume $10,000 worth of capital gains. I'm going to assume about $3,500 in dividend income, of which $1,900 is qualified dividends, which means they'll be taxed at the capital gains tax rates. That leaves $1,600 in ordinary income, which will be taxed just like the income on your interest and other ordinary income that you have. And I'm going to assume $3,000 of interest and other income that this couple has. I mapped out taxable withdrawals from the IRA from $30,000 to $135,000. And that will include what they're normally expected to take out for expenses, as well as a Roth conversion on top. What is the total tax hit? So I made a little spreadsheet and I tried to estimate that with this first attempt. So the way this works is I looked at capital gains first, and you've got 3 tax brackets for capital gains and qualified dividends. Keep your taxable income below $80,800 and you will pay 0 on your capital gains and your qualified dividends. If your income goes over that, you'll start to pay a 15% tax bracket, and that'll go up to all the way to $501,000. And after that, well, who are we kidding? It'll be a 20% capital gains tax. For ordinary income, the tax brackets for a married couple filing jointly are as follows. For 10% of your income up to $19,900, then 12% for your income up to $81,050, and then 22% tax bracket. Look at that jump for everything up to $172,750, and then a more modest income jump up to 24% as long as you stay below $329,850. And it goes up. I'm not going to worry about these. New Jersey income taxes are also in tax brackets, and that you have to consider for the taxable income of New Jersey. Add all the income up here. $10,000 worth of capital gains, which will be not taxed. $1,900, also not taxed. $1,600 in ordinary income, which will be taxable, and interest income and other income that will be taxable. I started with $30,000 of retirement income pulled out, taxable, because it's in a tax-deferred account, so you're pulling it out, you pay taxes on it. That'll give this person, in this first scenario, $46,500 of gross income, of which after a standard deduction for the couple with one person at 65, that'll be $20,050 of taxable income. And my first attempt was, okay, look that amount up on the ordinary income tax tables and figure out the tax and calculate it. Well, it's a little wrong. So this was my first attempt at a total tax hit. And it seemed to start higher than I thought, slope up, and then jump up a lot when New Jersey taxes and capital gains taxes kick in. But I wasn't sure about that, so I ran my numbers through a couple other sources, including my TurboTax. So I found another thing on the internet. This is done by Glenn Reeves. He has a Excel 1040 that he does in an Excel spreadsheet for modeling your income. And I went in and used his tool to see if I could come up with an estimate on what my taxes will be in 2021 for this scenario. So let me walk you through Glenn's spreadsheet, and I'll show you how I filled in the right numbers. I didn't go through everything, but I went through the pertinent numbers for this model. And there are no W-2s for the retired couple, but there are 1099 interest. So I put in an estimated payer of $3,000 worth of interest income. Likewise, on dividends, I put in $3,500 worth of ordinary dividends, of which $1,900 are qualified dividends from an estimated payer. And then for capital gains, so the capital gains Schedule D spreadsheet. Now here, I didn't have any short-term capital gains. I didn't enter those. But in the long-term capital gains, I put in a $20,000 proceed with $10,000 worth of cost basis, which gives you a $10,000 long-term capital gains. So back on the 1040 form, all of that comes up with a standard deduction. There's the income. You have taxable income of $20,050 and a tax calculated of only $818. That seemed far different from my first estimate. Well, how I adjusted the increments of IRA distributions is I did it on this page here, 1099R, and I did a gross distribution of $30,000. And then I went in and changed it to $35,000, and taxable amount is $35,000. And went through and just adjusted that in each of the steps, all the way up to $135,000 and $135,000. Everything else remained the same, just this changed. So as you see, the taxable income from IRA distributions is $135,000. And that brings your total income up to $151,000. After the standard deduction, your taxable income is $125,050, and that tax is $18,175. I took all of the numbers from Glenn's spreadsheet in Excel and just transferred those numbers over here, and you get a taxable federal. But I still have New Jersey to pay, so I added the impact that he had for taxable federal with my estimate for New Jersey and added it up to include that. So that graph's like this. It starts a little slower, much lower levels, has the same kind of trend line. I'm not thinking about the tripwires. As soon as you go over 22%, all of your income is 22% taxed. It doesn't work that way. There are certain parts of your income that will be taxed at 12%, and then an additional amount above that will be taxed at 22%. And so when you calculate those with Glenn's spreadsheet, you get a little smoother line. Well, that led me to go back to my numbers spreadsheet and see if I can come up with a second attempt to calculate this a little closer to reality. Again, taxable income of that, only $16,000 worth of taxable income in New Jersey, because all of your retirement income is excluded. So that added that up. In the first attempt, it was this formula. The second attempt now looks like this. And I'll bring up the edit formula to show this. And in fact, I'll stick a graphic here of the whole thing. So let's try to take a look at the formula that I'm currently using on this in a little more detail. It's taking the taxable income and it's subtracting the gains from your qualified dividends and capital gains. And again, that's a simplified version of what's going on. But you're also going to subtract the bottom of your tax bracket. And it's going to do that by looking up the taxable income minus the capital gains. So it's only concentrating on ordinary income. And it's going to look that up on the ordinary income tax page, which I've now added a lot of detail to include the bottom of the tax bracket. And it's going to look for that amount, and then it's going to find the amount that's in that bottom. And then it's going to take that amount, which is the income amount above the base, and times it by, look up that taxable income minus the capital gains again, and go look that up again. So this looks up that amount, which is the ordinary income in the scenario. And it's trying to find that number where it fits in on this column here. And it's going to return the taxable amount in this column here. And then it's matching the exact or the next smallest. So you're getting just the income that's taxed at that 12% tax bracket and eventually the 22% tax bracket. And then it's adding back an amount for the base tax in this tax scenario. And that's again doing another X lookup with that same sum of total taxable income minus the capital gains and dividend income. So it's ordinary income. Looking that ordinary income up here and returning the base tax. That gets added on to the number of the multiplication of the taxable income for the bracket times the tax rate. Now add back the base tax for the total tax. Now, you're not done because you do have to add whatever capital gains tax you have. And so you're going to look up that capital gain times Again, you got to look up the taxable income for the capital gains income tax impact. And I rearranged them this way, although I should tell you that the X lookup doesn't pay attention to the direction. So it's really flexible, a lot more flexible than VLOOKUP, for instance. So it's taking this and timesing it by what it finds here for the tax impact. And again, most of it's at 0% for this first scenario. The formula for New Jersey is very simple. So it's taking the New Jersey income and it's looking that New Jersey income up in the New Jersey tax brackets on the New Jersey page. And again, X lookup doesn't pay attention to direction, so it can use a horizontal roll like this. It's going to return the taxes. So New Jersey income is the important calculation here because of that exclusion. So it's taking all of your other income, adding that up along with a percentage of the retirement income based on a lookup of your gross income. And again, it's going to look that up on this table over here on the New Jersey income tax page. And it's going to return, depending upon where your numbers fall in this, it's going to return a percentage. So it's going to take the retirement income, in this case, $30,000, times it by 0% and include none of it. And likewise, and by the way, I just put in, to avoid errors, I put in tops of these. It continues. The more you earn, the more New Jersey takes. And that's how I did New Jersey. And so I went through and took my second attempt and added my second attempt to the New Jersey estimate to come up with this row of numbers here, this column of numbers here. Now, if you recall, this was the chart for the Excel plus New Jersey, and I'm pretty damn close to what Excel had with my second attempt at the calculations. I feel pretty good about these estimates. My first one was way off. Did a little bit more research into how exactly capital gains and the progressive tax brackets really work. Came back, changed the formula, thought about it to come up with a better estimate. So what does this assume for our couple here planning Roth conversions? Well, let's assume that the couple has already taken out $76,000, and that's what they need for their income to pay expenses. And let's assume that they're now thinking about, so how much more can I squeeze out of the IRA this year without hitting a tax tripwire? And in this case, we're going to go through and just explore changing this number. And any amount we change above this is a Roth conversion. So let's assume we go up to, let's say, $85,000. What happens? See, the New Jersey income tax starts to go up here. If I took this down to $80,000 here, so that's like a $4,000 Roth conversion. If I take a look at 83,000, so at 83,000, the total gross up here stays below that 100,000, and New Jersey taxes are low. Let me show you the top of the model. 135,000 would put this couple with taxable income of 125,000, again, because of the standard deductions. However, now start to look at the impact of taking that large Roth conversion. Your total gross is 151,000, which means your New Jersey taxes, surprise, went up to 9651, and you'll start to pay more capital gains. That's estimated out here that you'll see those hits. You start to pay more of those in the final tax calculation. Now, My method is a simple method on numbers. I'm not trying to be as precise as Glenn, but if you want to hone in on what your tax implication is going to be, I recommend this guy's website and his downloadable free tax return from this Google site. And I'll put a link to that site in my notes below. He notes that his tax spreadsheet is free. However, if you'd like to reach out and contribute something through one of his PayPal or Zelle or Google Pay, do so. And I'll let him know that you heard about this website from my little YouTube channel. As always, I am not a financial professional. I have no initials after my name. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need to.